What's up, everyone? It's Eric from ES Invest, and we are back at it again with another options video. Today, I want to talk about my hands down favorite option strategy. I've been trading this since 2007, so I've spent a lot of time developing it. And in my opinion, it's a better alternative to the wheel, and we'll get into exactly why that's the case. It is the covered strangle. So in order to kick us off, let's first start with, you guessed it, a disclaimer. I'm not a part of Bar Chart. I enjoy creating content and sharing information, so you shouldn't take anything I say that seriously and do your due diligence. Now, that part aside, let's get into what this thing is. Well, the covered strangle, as I've already mentioned, it's kind of like a wheel with a few more pieces added on. And this is actually why in the previous video I did, we started with a ratio covered call. And if you haven't seen that, check out the link in the notes below, because that's actually a big part of this strategy, which you'll find out in just a few moments. Now, what are the legs? Simple. We have one leg that starts as a cash secured put, which will look like this on a P&L graph, where your y-axis is your P&L, your x-axis is the underlying price. In this example, we're just looking at SPY. And you'll notice for a cash secured put, you have unlimited downside down to zero, and you have capped upside profit potential, which is one of the reasons why the covered strangle is an interesting alternative to the wheel, because we actually get rid of this capped upside in just a little bit. So we start with those cash secured puts. One of two scenarios will play out. Those cash secured puts will be out of the money at expiration, at which time you keep the premium that you collected, and then you can go on to sell another one. If your cash secured puts fall in the money, then you would buy the underlying take assignment, and then you would actually sell more cash secured puts against it, which kind of looks like this. So in this example here, we have long shares that we were assigned, and then we also sell additional cash secured puts against it. And kind of the total form of this, the final stage of the evolution, if this were Pokemon, is the entire covered strangle, which is when we have a ratio covered call, which simply put is long shares plus ratio short calls. Why a ratio? To uncap your upside profit potential. And then we add cash secured puts on top of it. That's it. So what's the big difference between this and the wheel? Well, if we were looking at the wheel right now, you would notice a couple key differences. Primarily, it would have this nice same downside risk potential, but then instead of the profit potential being uncapped to the upside, it would actually be flat. After a little while, you would hit a maximum profit potential, which this does not have. So this opens up a lot of opportunity to you as the trader to find different products that you like, that specifically bullish plays that you want to collect a little bit of premium on, but you don't want to cap your upside, because this is a giant deal. If you cap your upside potential in products like this, you'll notice very frequently covered call versions of strategies underperform if you just buy and hold whatever the same underlying is. And it's because of this. You are capping your upside potential. So when you are holding shares of a stock, of an ETF, there is an equity premium that you are attempting to capture, which is the upside movement of it. If we cap that upside movement, you actually are reducing the return on the risk you're taking, because you still have the same downside risk. You now just have capped upside. That's a big problem with the wheel. Now, the other thing that you can do with this is we're talking about adding additional cash secured puts. Why do we do this? Well, depending on the product that you're trading, if you are able to deploy additional capital, and we'll talk about that in just a second, it allows you to continue to capture premium through put skew, variance risk premiums, not directly pure play, but you will have short calls out and you will have short puts out. That allows you to capture volatility. So it will slightly reduce the total risk in the position, although I wouldn't hang your hat on this as some giant risk reduction thing. It's not. It'll hedge you a little bit to the downside, but not a ton. You still have to have good downside management in place. Now, one of the things I mentioned there was this idea of deploying more capital. As you could tell, this is a very capital intensive strategy. It's designed to be traded in something that you really want to own. And bar chart has a great tool to help you find that exact thing that you want to own. And if you take a look here, you can set filters to search for specific traits that you want to see in whatever it is you're going to buy. So the way that I think about trading the covered strangle is this is a long thesis trade. This means we're not looking for something to go flat. We're not looking for something to go down just a little bit. We want it to go up. That's where our max profit is. We want to make sure our profit to the upside is uncapped, as I've mentioned. And as with any trade you put on, you should have a clear definition of your profit management and your loss management throughout the entire life cycle of the trade. Because sometimes you might sell a cash secured put to have something crash, and then you're starting to think for yourself, oh, well, do I actually still want this? Maybe, maybe not. You have to make the decision for yourself, but you should absolutely define it before you enter the trade. Now, the last thing I want to talk about here are kind of these different choices you have with respect to things like what ratio do you use? What days to expiration should we pick? What delta makes sense? And all of this starts with deciding how much money this trade gets. And I do that through what's called an allocation process. I have a total trade allocation. So I look at the position, I look at how it fits in my portfolio, and I'll see how much money from my entire portfolio will this position get over its entire life cycle up to a maximum number. Then I have what's called an initial outlay. Of that total allocation, how much money am I going to use up front? That's going to inform things like how many cash secured puts am I going to sell? If I'm selling short calls against my long shares, well, in order to maintain uncapped upside, if you only have 100 shares, you can't sell any calls because then you have capped upside potential. So in that case, I might need to make sure I can get 125 shares or 150 shares. You have to figure out what's right for you. But the other thing to keep in mind is once you're assigned on this first round of cash secured puts, the entire intention is to add more. So if you have $50,000 allocated to a position and you use all 50,000 via the initial sale of all of your short puts, well, that means you don't have any money to add more to it if you get assigned on your first outlay of cash secured puts. So you have to think through what ratios and what outlays, and then finally what scaling protocols make sense. So after you sell this first round of cash secured puts and you get assigned eventually, how many more do you want to sell on the next round? And then how many on the next round after that? So thinking through those details up front is really important to creating a risk to reward profile that makes sense for you. Now, as far as days to expiration, this is pretty simple. I think in general, if you are selling options, I try to sell within 50 days. That's basically it. I want to get closer to maximize theta decay. You're not super concerned with how much time or how much gamma is going to spike because of how little time is left, because the options are covered. So that risk is not really significant to you. You have to figure out what strikes make sense. And the way that I think about that is specifically with the ratio short calls, it's pretty simple. If you sell at a higher ratio, that means that you are collecting more money up front, but you're giving up upside potential. If you sell a lower ratio, meaning if you have 500 shares of SPY and you only sell 2 calls against it, it's a low ratio. In that case, you would have more upside potential, but you're collecting less money up front. So part of that comes down to your disposition on how you feel about that in the trade that you're in specifically. Now, when we're looking at what strikes to pick, the further out of the money you go, specifically for your short calls or short puts, the less money you're going to collect, but the further the product has to move before your options start to fall in the money. So again, it depends on how you feel about either your cash secured puts or short calls falling in the money. So a great example. If I have something and the trade has kind of naturally run its course and I'm ready to get out of it, then a lot of times I'll actually sell my short calls either right at the money or slightly in the money to get a sign to unwind the long shares to exit the position. Now, obviously, you have to track your basis to make sure that you're not selling short calls below your cost basis, locking in a loss on your shares. We don't want to do that. Now, the last thing to think about is one of the biggest issues I see traders make when they're running things like the wheel, the covered strangle, cash puts, is not having a long enough time horizon on the trade. If you're trying to trade this for really short-term time frames, you're probably going to struggle, because a big benefit of this is to have the upside drift potential of long shares, but to enhance it with short option premium on the call and the puts. So if you have any questions, let me know. I have a bunch of videos on my channel about this exact strategy that goes super far in depth, but it's a favorite of mine. I'd love to know your thoughts. Don't forget to like the video, be an outlier. See you guys later.